Welcome to the deep dive. It is Saturday, February 28th, 2026, and wow, we are stepping into a weekend where a massive convergence of geopolitics and market volatility has just completely upended the headlines.
Yeah, it's been a truly historic 24 hours.
It really has. We have an incredibly packed mission for you today. First, we are going to unpack the breaking, genuinely shocking news of today's U.S. and Israel military strikes on Iran.
Right.
And we'll look at the immediate financial shockwaves that are already rippling across the weekend markets. Then we need to pull back and dissect what was already a wild historic week on Wall Street, even before this morning.
Exactly. The market was already fracturing.
We're looking at a seismic shift in the AI landscape, some truly idiosyncratic stock movers, and a violent rotation into commodities, bonds, and crypto.
We've got a formidable stack of sources to help you make sense of it all today.
Yeah, breaking news wires, weekend market reports, deep financial Substack columns, international analyst breakdowns. It's a lot. Okay, let's unpack this. We have to start with the breaking news today out of the Middle East.
Right, but before we get into the specific timeline of those strikes and, the immediate market reactions, I need to state something very explicitly for you, our listener.
Go ahead.
We are about to discuss highly politically charged actions involving the United States, specifically President Trump's administration, as well as the governments of Israel and Iran.
Yeah.
The mission of this deep dive takes absolutely no political sides. Our goal is not to endorse, support, or condemn any of the viewpoints, policies, or military actions contained in our source material.
We're just looking at the facts.
Exactly. We are simply and impartially reporting the facts exactly as they appear in our sources to help you understand the current geopolitical landscape and its very real impact on global markets.
And the facts on the ground are moving incredibly fast right now. So let's lay out the timeline based on the breaking wires we received this morning.
Yeah, it started early today.
Early today, February 28th, Israel, acting in direct coordination with the U.S., launched what they are calling a major combat operation. The sources indicate they are targeting Iranian military sites, intelligence hubs, and this is key areas in central Tehran directly adjacent to Supreme Leader Ayatollah Khamenei's office.
The imagery coming across the wires is intense. The sky over Tehran is filled with smoke.
And this is happening just as millions of Iranians were heading to work and school on the first day of their work week.
Yeah, to understand the gravity of today's events, we have to look at the immediate backdrop. I mean, this was not a bolt from the blue.
No, the tension has been building.
Just prior to the strikes, President Trump released an 8-minute video on Truth Social confirming the operations.
8 minutes, yeah.
In that broadcast, he threatened the complete annihilation of Iran's navy and issued a stark warning to the Islamic Revolutionary Guard to lay down their arms immediately or face destruction.
Which, we also have to view through the lens of recent history.
Exactly. This new offensive follows that intense 12-day air war from back in June of 2025.
Right, where the U.S. directly bombed 3 key Iranian nuclear facilities.
And Iran retaliated by firing missiles at the Al Udeid air base in Qatar.
The largest U.S. base in the Middle East. The tension has literally been boiling over for months.
Yeah.
And what we are seeing today is the market reacting in real time, instantly pricing in the fear of a much broader, sustained regional war.
The reaction was violent.
Walk us through the immediate financial fallout, because it was instantaneous across the assets that trade over the weekend. Like, what happened with Bitcoin?
It was a brutal sequence. Within 15 minutes of the news breaking, Bitcoin suffered a massive flash crash, plunging below $64,000.
Wow.
And what is staggering is the collateral damage underneath that headline number. In that short 15-minute window, over $100 million worth of levered long positions in crypto were completely wiped out.
For anyone unfamiliar with the mechanics there, those were traders using borrowed money to amplify their bets that Bitcoin would go up.
Right. When the price suddenly dropped on the geopolitical news, the exchanges automatically liquidated their positions. It was a total wipeout.
Meanwhile, the traditional safe havens caught an immediate massive bid. Gold surged on the news, topping out at an astonishing $5,200 an ounce.
Unprecedented levels.
And oil, which had already been climbing throughout the week, spiked violently. We saw the U.S. benchmark, WTI crude, pushing near $67 a barrel, and Brent crude nearing $72.50.
You look at those numbers, and you really have to wonder what the opening bell is going to look like on Monday morning.
It's going to be chaotic.
If we connect this to the bigger picture, what makes today's geopolitical shock so profound is that it is hitting a global market that was already fracturing.
Right. The foundation was showing severe structural turbulence over the last 5 trading days.
The market was snapping before a single missile was fired today.
The broader macro landscape was definitely showing cracks. I mean, even before the weekend, the Dow lost its 10-month winning streak.
Yep.
Both the S&P 500 and the Nasdaq recorded their largest monthly drop since early 2025. A major catalyst for that anxiety was the U.S. Producer Price Index.
The PPI.
Yeah, the PPI, which came in hot. It jumped 0.5% in January.
And the immediate narrative in the financial press was this resurgence of inflation.
But the sources point out this headline number is actually masking what is really happening under the hood. So if raw goods are actually getting cheaper, what is driving that 0.5% jump? Unpack that trade service margin for us.
That is the critical distinction here. When you peel back the layers of the PPI data, you see that the inflation wasn't in raw materials or supply chains.
Right.
In fact, the prices of final demand goods actually fell by 0.3%. Energy goods dropped 2.7%, and food prices fell 1.5%.
So you are not seeing a shock in the cost of steel or semiconductors.
Exactly. That 0.5% jump was almost entirely driven by a 2.5% spike in trade service margins.
Okay, and what exactly does that measure?
That metric essentially measures the spread between what a wholesaler or retailer pays for a product and what they sell it for. It's their markup.
Oh, I see.
Retailers and wholesalers are aggressively trying to rebuild their profit margins after periods of contraction.
So it's a margin story, not a 1970s-style supply chain inflation crisis. But even if it is just retailers padding their margins, that hot data print still handcuffs the Federal Reserve, right?
It does. The consensus among the analysts we reviewed is that this effectively forces the Fed to hold interest rates steady at these high levels until at least the summer.
Which brings us to a frankly terrifying statistic when you combine it with those high interest rates. According to our sources, global debt just surged by $29 trillion in 2025 alone.
It's a massive number.
That brings the total global debt pile to a record-breaking $348 trillion.
The biggest annual increase since the pandemic in 2020.
And governments alone added $10 trillion to that pile. You have sovereign nations borrowing at record levels while interest rates are stuck in a restrictive stance.
And then you add in the fact that the U.S. Supreme Court just struck down President Trump's global emergency tariffs,
prompting the administration to vow that new, even steeper tariffs are coming.
Right. So you have a market swimming in a historic level of uncertainty.
And right in the middle of all that macro anxiety, we had what the sources are calling the anthropic interruption. This feels like a defining moment for the tech sector.
It is a watershed moment. Anthropic, which is obviously one of the premier artificial intelligence companies, formally rejected U.S. Defense Secretary Hegseth's final offer for a massive government contract.
And they walked away for ethical reasons.
Yeah. Anthropic cited strict ethical concerns as their reason for walking away. They specifically stated that their technology should not be utilized for the mass surveillance of American citizens, nor should it be used to power autonomous weapons systems.
The administration's response was swift and punitive.
Very much so.
President Trump immediately banned Anthropic's technology across the entire U.S. government, labeling the company a supply chain risk.
And the market impact of this single policy decision was absolute devastation for the broader software sector.
It erased $100 billion in market capitalization across software and cybersecurity stocks almost instantly.
We saw IBM suffer its largest daily decline since October of 2000. Cybersecurity stocks plunged by 20% across the board.
It was a bloodbath.
And this is not just a one-day panic reaction. Hedge funds are currently shorting U.S. software stocks at a record level of 3.8%.
Wow.
Their long-short ratio for this sector has plummeted to an all-time low. The smart money is actively betting against legacy software.
We are watching a leading AI company draw a line in the sand over its business ethics, going head-to-head with the White House, and Wall Street is realizing that the defensive moats of traditional software companies can be evaporated by a single blog post or government policy shift.
Capital is fleeing digital software at a record pace.
The vital question for anyone managing money right now is, where is that capital going?
It is not just sitting in cash. It is pouring directly into physical infrastructure and AI hardware.
Right, and you cannot talk about physical AI hardware without talking about Nvidia, and their stock had a remarkably strange week.
Very strange.
They completely crushed their Q4 earnings expectations and issued incredibly strong future guidance. Yet, the stock ended the session down 5.5%.
But here's the fascinating divergence. While the stock dropped, Individual retail investors bought a record $360 million worth of Nvidia shares in just the first 80 minutes of trading.
Why were retail investors so eager to buy the dip while institutional money was aggressively selling?
Institutional money was taking profits. Nvidia has had an astronomical run, and portfolio managers were locking in those gains amidst all the macro uncertainty we just discussed.
Makes sense.
Retail investors, however, were looking past the immediate volatility and focusing on the underlying engine of the company. The true story of Nvidia right now isn't just the stock price. It is their operational methodology.
Yeah, our sources highlight a core tenet of their corporate culture called the speed of light.
Which is fascinating.
I found that concept absolutely fascinating in the reading. Explain how that speed of light benchmark changes how they engineer their hardware.
Well, at a typical technology company, success is measured by incremental KPIs. You aim to be 10% faster than your own last generation of chips, or maybe 15% better than your closest rival.
Standard corporate benchmark.
Right. But at Nvidia, that mindset is considered a failure. They do not benchmark against competitors. They benchmark against the absolute limits of physics.
Wow.
They ask the engineers, if there were zero data lag, zero network queues, and perfect thermal conditions, what is physically, mathematically possible, then they engineer backwards from that absolute limit to see how close they can get.
We just saw that philosophy play out in real time with their recent acquisition. Nvidia bought an AI inferencing startup called Grok late last December.
And most industry analysts projected it would take years to integrate that new architecture.
Instead, operating at the speed of light, Nvidia integrated Grok's assets and talent in just 3 months.
3 months, it's unheard of.
They are now set to unveil a game-changing new inference chip at their GTC developer conference next month in San Jose.
And for those keeping track at home, an inference chip provides the brainpower needed to actually run the AI efficiently after it has already been trained.
And they already have a massive buyer lined up.
OpenAI has reportedly agreed to be one of the largest customers for this new processor.
That is a massive operational win for Nvidia and a major acceleration in the AI hardware race.
And this physical hardware dominance is lifting other infrastructure companies. Look at Dell Technologies.
Yeah, their stock skyrocketed 21.9% after reporting an incredibly strong forecast specifically for their AI-optimized servers.
Keysight Technologies is another prime example of this rotation. They jumped 23.1% after issuing a blowout earnings forecast.
They manufacture electronic test equipment, right?
Yes, and they are seeing massive sustained demand from telecom and defense customers who are physically building out these massive data centers.
It is a complete structural rotation out of digital software and into tangible, physical tech hardware.
But that rotation isn't strictly limited to companies building servers and chips. We saw brilliant strategic moves in the consumer space that reflect a similar understanding of the changing landscape.
Here's where it gets really interesting. Let's look at the streaming wars. Netflix saw its stock jump 13.8% this week.
And they didn't achieve that by announcing some massive new acquisition.
No, they did it by walking away from one. Netflix formally abandoned a colossal $70 billion bid to acquire Warner Bros. Discovery, which of course owns the entire HBO catalog.
And Wall Street heavily rewarded that restraint. It demonstrated immense capital discipline.
Right.
Dropping $70 billion on legacy content is a strategy tailored for the old media world, and the landscape of how consumers interact with video is shifting dramatically beneath our feet.
Oh wait, let's play devil's advocate here.
Yeah.
Doesn't passing on massive, culturally dominant legacy IP like the Harry Potter universe, Batman, and the entire HBO back catalog leave a huge gap in Netflix's armor?
You would think so.
Why is the market cheering for them to walk away from that kind of premium content?
Because the premium content isn't the primary battlefield anymore. The distribution screen is.
Oh.
One of the deep dive sources explicitly pointed out how YouTube is increasingly becoming the dominant screen in the living room.
That's a huge shift.
Consumers aren't just watching 3-minute clips on their phones anymore. They're watching full-length 2-hour movies and deeply produced video essays for free on YouTube through their smart TVs.
So YouTube is directly attacking Netflix's core distribution dominance.
Exactly. If Netflix had burned $70 billion acquiring old HBO shows, they would be fighting the last war. Conserving that capital to focus on organic growth, live events, and their core platform shows they understand the true threat.
It proves you cannot buy your way out of technological disruption using legacy assets. You have to adapt your core model.
Very true.
And as we look at the broader asset classes, commodities, bonds, crypto, this overarching theme of moving away from vulnerable digital assets and toward tangible, physical reality is dominating the tape.
With software valuations crashing, global debt hitting that staggering $348 trillion mark, and geopolitical uncertainty peaking with today's military strikes on Iran, capital is desperately searching for safety and tangible value.
We saw a classic flight to safety in the bond market, with the 10-year U.S. Treasury yield dropping to 3.96% as investors sought refuge in government debt.
But the really aggressive, explosive moves were in the physical metals. Silver spiked 3.9% to 90.7 cents an ounce.
And as we discussed at the top of the show, gold sustained massive highs, pushing past $5,200 an ounce today.
Investors are actively building hedges against Trump's potential new global tariffs and the rapidly escalating war in the Middle East.
We also have to watch the energy markets closely. Oil closed the week higher strictly on the tension with Iran.
But for you listening right now, you need to circle a specific date on your calendar. Keep your eyes on March 4th.
What happens on March 4th?
That is the date of the upcoming OPEC meeting. OPEC Plus ministers are convening to decide on oil output policy for April.
Oh, wow. Given the military strikes that occurred today and the fact that Iran is a major player in that region, any surprise from OPEC regarding production cuts could swing crude prices violently.
It is going to be a highly volatile week for the global energy complex.
I want to return briefly to that intersection of technology and defense, because the fallout from Anthropic saying no to the Pentagon didn't just end with a software market crash.
Right, nature abhors a vacuum.
Exactly. Where there is a massive financial vacuum, someone will always fill it. After Anthropic was banned by the U.S. government, OpenAI immediately swooped in.
They secured a staggering $110 billion funding round.
Backed by heavyweights like SoftBank, Nvidia, and Amazon, this new round values OpenAI at an eye-watering $840 billion.
And they are actively working on a deal for the exact Pentagon contract that Anthropic walked away from.
It highlights the frenzied, almost desperate nature of the AI arms race. And OpenAI is not alone in filling that void.
No. Elon Musk's xAI, which developed the Grok model, also signed a deal this week to let the military use its technology in highly classified systems.
So while one company steps back, citing the ethics of surveillance and weaponry, others are rapidly stepping forward.
And they are being funded by hundreds of billions of dollars to actively power the defense and intelligence infrastructure of the United States.
It is a profound shift in how the modern military-industrial complex operates. But amidst all this intense discussion of autonomous AI, global debt spirals, and geopolitical warfare, I want to toss in a surprisingly grounded, almost mundane statistic for you.
Let's hear it.
Despite the futuristic AI wars happening in the cloud, the traditional physical office is actually making a comeback.
Really?
Yeah. Average office attendance in 10 major U.S. cities just hit 54.7%. That is the highest attendance rate we've seen since the pandemic began in early 2020.
It is a fascinating counter-narrative to the rest of the week's news.
It really is.
Give that juxtaposition some thought. We are spending trillions of dollars building the most advanced digital intelligence and human history systems designed to automate tasks and operate autonomously.
Yet, simultaneously, the physical reality of human beings gathering in a room, sitting in cubicles, and collaborating face-to-face is reasserting itself.
It mirrors the broader market rotation perfectly away from the purely digital illusions and back toward the physical, tangible world.
When we put all these pieces together, the picture becomes starkly clear. The world is experiencing a massive, historic rotation.
Capital is moving aggressively out of traditional software and digital services.
It is pouring heavily into physical AI infrastructure like Nvidia and Dell. It is flowing into the defense sector with OpenAI and xAI partnering with the Pentagon.
And it is seeking the ultimate tangible safe havens like gold, silver, and oil.
All of this economic repositioning is being violently accelerated by extreme geopolitical volatility, culminating in today's shocking military strikes by the U.S. and Israel on Iran.
This raises an important question, and it's the thought I want to leave you with today as you process this weekend's events.
What's the question?
We are currently witnessing an era where an AI company like Anthropic feels powerful enough to directly challenge the United States military over the deployment of autonomous weapons.
Right.
At the exact same time, we have other private companies like OpenAI and xAI stepping in with near trillion-dollar valuations to build the classified intelligence systems that the military increasingly relies on.
Yeah.
As we watch sovereign nations launch physical missiles, using highly advanced weaponry today who actually holds the ultimate geopolitical leverage in the 21st century?
Wow.
Is it the sovereign governments who order the missile strikes? Or is it the private, unelected tech companies that are building the autonomous intelligence required to power them?
That is a brilliant and slightly terrifying thought to leave off on. We are watching the balance of global power shift in real time, right before our eyes. Thank you so much for joining us on this deep dive.
The headlines are moving fast, and the world is changing even faster.
Keep questioning what you read, look for the deeper structural shifts, and we will see you next time.